the strangest feeling to know what to believe in.
Hi, George Rivera here with Simple Lending Mortgage LLC, independent mortgage broker licensed in the state of Florida and Georgia. Today, we want to go ahead and do a video about investor loans. The reason why we're going to go ahead and talk about this specific topic in this video separately is because we've been having a lot of feedback, replies, and questions about the programs, how they work, whether how complex or how simple they are. We wanted to go ahead and use this that it's going to be in terms that it's going to be simple for whether you are a buyer, an investor, or a realtor. So we can keep the verbiage to a minimum so that it can be easy for everybody to understand. And as always, if you have any questions, you can always leave us a comment. You can always hit us by email or give us a call. All of that information we'll go ahead and present below. So let's go ahead and get into some of this program. So awesome things that you can consider for real estate investing is that most of these programs are only going to require FICO scores. For instance, the bridge lending, the fix and flip, fix and rent, stabilize, the DSCR, they're all going to require FICO scores to be the best. Honestly, the best place is 680 and above. We do have some lenders and investors that will do those for 640 FICOs. They're going to either require a slightly bigger down payment or you're going to have slightly higher interest rates. We're noticing that the combination of price to rate is making it a little difficult for the rental income to wash out to the payment unless you put a bigger down payment and choose a longer term or interest only. Those options are there, but besides having the funds for down payment and closing costs and having a credit score, none of these programs are actually requiring pay stubs, W-2s, and tax returns. They're actually going to be stated income, or the income is going to come from the property itself, because these are equity-based lending decisions that they're making. So understand there is a split. Conforming or conventional loans such as Fannie Mae and Freddie Mac, they do offer second home and investment loans. They have limited properties that you can have to the portfolio, but they are also, when you go conventional, like for instance, Fannie Mae, and you're using that to get an investment property, because it is conventional, it is full documented, right? Which means it is going to be credit score based, debt to income. You have to report and show for your income, whether it be your pay stubs and W-2s, tax returns. So your income is going to be derived from that. If you are not a first-time home investor, they will take in consideration the properties that you already own. And they're going to take in consideration the mortgage payment to those properties, the rental income that you get from those properties, in order to help alleviate that debt to income ratio. If you are a new investor who have a property, but yet you haven't been renting it for long enough to have 2-year taxes, even though there's a certain calculation that is done, we have noticed that in the grand scheme of things, this debt to income calculation on the conforming conventional loan method seems to put a lot of the investor buyers in a tighter situation because, again, it's fully documented. So on the non-QMs, meaning non-qualified mortgage, which is outside of the conforming conventional, there's a lot of private lenders out there that have pool of funds to be able to allow loans to investors, and they are limited documentation requirements for these type of loans, which as a whole, what we've been noticing, the more we've been working with this program, the more we've been familiarizing ourselves with this program. Also dealing with different investors of different types, different sizes, we're noticing that a lot of the bigger investors actually opt for this type of programs products because it facilitates when it comes to doing your taxes, tax bracket, tax loopholes, because there is a lot of advantages to investors that invest in real estate. So some of this, and a lot of times when they do their taxes, it doesn't give the net income that you would need for debt to income calculation. So by taking this limited document approach, where your income is not reviewed the same way, it facilitates. And we're going to go ahead and cover those here in just a second. And I'm going to go in order of some of these programs because I want to make sure I touch the different options out there for the different buyer investor. So first, we're going to go ahead and talk about bridge lending. So bridge lending just means just the term of the bridge. It's just something to help you get from this point to this point. Simply that. Most of lenders will do a bridge loan, 1 to 2 year term. They're very short term in nature. Um, some lenders, some investors will use this type of loan so that they can acquire a property, where it's going to be most of the time it's going to be an interest only loan, which is a benefit. You get the money is facilitated to you. Most often than not, you're going to find a 20 to 25% down payment for that type of loan. Some lenders will do a 20% down. Some will require a minimum of 25. There is a pro and con to that. I've noticed that some lenders that will require the 25% down because of the loan to value, because there was more down payment, which means the investment project has more equity. We've noticed that there has been slightly better interest rates. This will be the 1 2 year term. No prepayment penalties because they are actually meant to be short term. Again, 80 to 75 LTV, which would translate to 20 or 25% down. Stated income. They'll require income documentation as far as to verify the validity that you're not going to be stuck with a loan that you can't get out of. Most of these loans are stated income or no income verification. And those will let you do for purchases, rate and term refinancing, cash out refinancing. And again, as far as the payment term, it would be, for instance, if you do the 20% down option, you would just have your 20% down. You would have whatever points or fees the lender will charge for this type of loan. You will have your closing costs. The interest rates is not based at all on whatever you see in the news for interest rates and mortgage rates. These rates are not aligned in any way with the mortgage interest rates because those are residential mortgage rates with MBS. And these are going to be based on these private investors that pulled these funds together, that you could lend from. They'll basically be wanting to determine a percentage of profit that they want to make. So whatever the going rate is from the bank to them, they'll add on what the percentage they want to make on that loan. So those rates can definitely vary depending on what the market is. At one point, we saw those rates be in the sevens. We saw them jump to the nines. And right now, bridge loans, we're seeing them anywhere from 8.99 to 12%. And again, that will be an interest only payment that you would be making while you stabilize or work with the property. I had a buyer, for instance, to give you a scenario, where the buyer saw the property. It was a really good deal that the customer could not wait to restructure certain things in his business to acquire. The bridge loan facilitated this buyer to acquire the property today and allow this person to restructure some things in his business with his taxes so that he can refinance out of it in the future into a conforming loan. So the loan facilitated for that. Then we're going to go ahead and talk, since we brought it up. We're going to go into detail on the fix and flip or fix and rent. This is basically another form of the bridge loan. It is a short term loan, 1 to 2 years, no prepayment penalties, because, again, intended purpose of the loan is for you to do what you need to do with the house, basically stabilize your property so that you can get out of it. 25% down. Most lenders that I have with this program will do up to 100% of your rehab budget. What does this mean to you? It means that, imagine if you were able to borrow the money needed required to purchase a distressed property, and you were able to buy the property and also borrow the money needed to fix the property. So now you're being lended the money to buy and fix. So now with this 1 or 2 year term, you have the time to buy it, to get your contractors and get your your GC, whether it's your handymans, so they can do the job needed, whether it's to, whether you're trying to take a wall down, you're trying to make it into an open floor concept, make the house more modern, more attractive to the market. Maybe there's some required repairs that you have to do to the property because it's not financeable to a buyer the way it is. You want to either rehab or renovate. Those funds are 100%. Now, the way it works is like this. This is a little different than what you've probably heard with FHA 203K or the VA renovation loan. At closing, this money that you need to fix the house is not given to you up front. The way this loan will be structured is there will be what is called a rehab budget form. So you're going to let the lender know this is the purchase price and this is the estimated cost of repairs between, whether you're going to do something in the kitchen. Well, I'm going to drop 12,000 in the kitchen because I'm going to want to go ahead and resurface the cabinets. I'm going to put a new countertop. I'm going to put new appliances. I'm also going to need about 8 for the bathrooms because I'm going to modernize the vanities, the vanity tops, the sinks. You have to go into specific details. So it does matter whenever you do these things to get a contractor to go ahead and review the house, review with you the notes on what you intend to do with this property so you can get that bid so it can be broken down on the work you're going to do to this house, the cost is going to be to work in this house. So when this is sent to the lender is going to go ahead and give you your pre-qualification approval so that you can go ahead and buy the property. The lender will not surrender or give you any of the rehab budget first. The way it works is like this: the lender is going to you pay the work out of pocket up front. You can break the project down in sections. For instance, let's say you want to go ahead and do the kitchen first. And the kitchen costs you $12,000 and you spend the $12,000. When you're done with the kitchen work, you notify us, we notify the lender. The lender will send somebody to see that that job was done. They'll see the work performed compared to the bids. And once they can see that that money was spent in what they did, they'll give you that money back. Once that money is given to you, at that point, the interest on that money becomes due. So if you buy a house, let's say, for sake, keeping numbers easy, let's say you buy a house for $200,000. And out of this 200, you think you're going to need to put about $30,000 into the house. But once you put the 30,000 into it, you're basically now in it for 230. But you know the numbers and you went through them and you can sell this house to make a good profit. We're talking about 25% equity from what you got. So at that point, you know that you're going to go ahead and spend the money. You're going to get the money back. You did the kitchen. Now you're going to go into the bathrooms. So now that you will rehab the money, now the lender has given you the 200 to buy the house and you've been paying interest only on that 200. Now that you call for the $12,000 to spend in the kitchen to be given to you, now you're going to start paying interest on the 200 plus 12. So now you're paying interest on the 212. So you only pay interest on what you have drawn. It's important to say that because it makes a big difference. Because you don't pay interest on the whole bulk of it because it is not given to you. It is on a draw system, so no interest on the undrawn funds. Now, I have some of the lenders that if you're able to get your contractor to do the job first and invoice you at the end of the completion of the job, you can actually at that point call the lender, show the work done in the invoice, and when the lender pays the drawn funds, it goes straight to that contractor that did the job. So therefore, you never really came out of pocket. And no, it's hard to find a contractor that will always do the job up front, strictly to invoice you at completion of the job done. But we've had some clients that have been able to successfully do so, and it's stated income because they're not looking at the income with this type of program. They're not worried about how much you make because, again, they're basing everything on equities, equity based lending. They have confirmed with their appraisal what is going to be the as is value to justify why they're giving you the 200 right now, that the house is indeed worth 200,000 at this point. And then they're going to go ahead and do the after repair value when the appraisal is given a copy of exactly what the house will be worth after all of the jobs performed will be. They need to make sure that the house is going to be valued above what they're giving you. And it's an interest only payment that you'll be making until you have stabilized the property where you can rent it, or you have already fixed the house and now you're ready to flip it and make the sale. And then obviously the loan will be paid off um, with the proceeds of the sale of the property. Next one, we're going to talk about DSCR. This is a debt service coverage ratio. This loan is actually pretty darn good. We've done a plethora number on them, and I think this has so many benefits for investors. Um, right now, the rental market is rapidly growing because the combination of rates as far as we're having interest rates going up, we're having purchase prices going up, and we have a lot of buyers that, due to those unfortunate situations, are not able to purchase at this time. They need to live somewhere. So renting is going up, but we cannot keep up with demand. We see in the news, there was some statistics that we're having a lot of people going back to live with their parents because they can either rent or buy. Um, Renting is, it is something that will help you not only build your house portfolio, rental portfolio, but it's something that is going to be in demand for years to come because we still have need of inventory. um, DSCR is a super easy way of doing this. It's 30-year terms, 40-year terms. You can do interest only. You can do with principal and interest. 25% down. They're looking at your credit score. There's no income required because the income for a DSCR loan is actually, they're going to take and look at what is your mortgage payment. If your mortgage payment for you to acquire this house, between principal, interest, taxes, insurance, if your total payment is going to be $1,300, they just want to make sure that you have the ability to rent this property for a sufficient amount that the rental income will cover the mortgage payment. Now, you may want to calculate and adjust that yourself, but it will not work that way, because the property has not yet been rented. They're going to, when they order the appraisal, they're going to order what is called a 1007. So in the 1007 is when the appraiser goes out and he don't just appraise the property, but he is also going to give us what is the market rent analysis report. This is going to let us know, based on comparables, how much could this property rent for. Now, you may be able to personally rent it for more, but for the lender's purposes, they cannot use a higher amount that when they can verify that it's common rent amount for that property. The DSCR ratio, for the best terms, is 1.15. So how does that work? 1 to 1 is simple. 1 to 1 means that if your payment is $1,500 to that mortgage, you got to rent it for at least $1,500. So what we're looking at is the following. So if, let's say that your mortgage payment for this rental property you're acquiring, with everything combined, principal, interest, taxes, and insurance, if your total payment is $1,300, that means that you would have to be able to rent it for no less than $1,500. The way you will calculate that would be, you would divide the rental income divided by mortgage payment, and you get your number. So if you get a 1.15, at least you got your 1.15. If you're getting less than that, then you have to look at changing the loan terms by trying to make sure that your mortgage payment comes low enough that when you divide that rental income that you get from the appraisal, when you divide that by the mortgage payment, you get at least the 1.15. Now, we have lenders that will do down to a 0.85, which means that you're actually slightly under. All right. So now the ability of going down to a 0.85 on the DSCR ratio, that would actually mean that, for instance, if your mortgage payment is $1,300 to your lender and you rent it for 1110, that will give you a 0.85. So what this means is that you're actually not being able to rent it for as much as your mortgage payment. Some investors will actually do this because they believe in the property potential. They see something coming in that near future in that market area, or they just want to make that property acquisition, and they're satisfied with the fact that they're going to put a renter in that property, and that renter is going to cover basically that 85% of that mortgage payment. And what they're looking for is just that the rental income is going to alleviate the mortgage payment, but they want that property acquisition. But again, with these loan programs, there is no income other than that. That's all they look for. In a perfect case scenario with the 1.15, 1.25, you get the best terms. Like we said, you could have a lesser DSCR ratio, which means that your rental income may not be as much. This does change some of the terms of the loan, whether requiring a bigger down payment, getting some interest rate adjustments where your interest rate will be a bit higher. But it's the facility of you getting the property acquisitions. Now, mind you, because we do acknowledge that we're having a little anomaly right now between houses being priced so high as well as interest rates being so high. some of the things we're noticing from conversating with investors is that what they're focused on is that they know they want to get this acquisition because they know the rental market is going to have such a high demand. And they know that at some point the rates are going to come down from where we are today. And when rates come down, they can restructure the loan because they can always refinance it into a lower rate, which will open up for them the income revenue to come in. And right now the concern is to be able to acquire these properties because again, there's short inventory, supply and demand. If you can't buy, you're going to at least want to rent. So that's why the DSCR has been such a big thing, and it hasn't seemed to slow down. Other than the numbers seems to kind of they clash when you're trying to get your rental to be able to cover the payment. But the reason why the payment is high is because the combination of home price with interest rate. But what we're learning from a lot of investors, what they're focused on is they're looking for the property acquisition restructure when the rates drop later. Because as long as they can at least make it work where they have the tenant in place where the renter is covering that mortgage, then that mortgage is no longer an expense, but it's something they have now in their portfolio. And there is significant tax benefits in real estate investing. I will not give neither legal or tax advices because that is not my role. I recommend you get either a CPA, an accountant that could better explain all of the benefits available to you as an investor in real estate. But there is a vast number of benefits for real estate investing. So I think that will help us cover what we have, what we offer, how you can help your customer, and how you yourself can become an investor.